It works. Okay. Good morning, everybody. Thank you, Peter, and the rest of the organizers for inviting me here to give a plenary talk. I'm really happy, honestly, to be able to give this talk because of the topic in particular. I'm going to talk about financial engineering. So I think there is a big misconception in this community about what it is financial engineering. Basically, years ago, I used to work in another area. I used to be in communication systems. And now when I need to tell my colleagues that I'm working in financial engineering, they look at me with this face. It's a face that I can recognize. It's not a nice face. They try to hide it. There is something going on. They don't like it. And I don't know why. Basically, I don't know what they think financial engineering is. So that's the issue, right? I think there is a misconception. So my point today is to try to tell you that really signal processing is everywhere within financial engineering. You will see. No matter what you do. Some people work on random matrix theory. Some people work on particle filtering, Kalman filtering, robust optimization, optimization algorithms, machine learning, deep learning, stochastic optimization, chance constraints, any topic that you want. Different people work on different areas. I'm sure you can find a place here. So that's the point of this talk. Let's see if I manage. So basically, there are so many things that I want to tell you, right? That's a problem because I don't have the time to tell you about everything. So I had to choose. But there are many other things, really. There are many other things that are really beautiful for us, for people in signal processing. So I was planning to tell you about my personal story first, but I'm going to skip that because there is no time. I wanted to tell you, because I switched to this area like 10 years ago, so it was not an easy path. So I wanted to tell you stories, but no time, I'm sorry. So today I want to tell you a few topics. One is this, about robust estimation, which is very important for finance. Then I want to tell you about Kalman. Kalman it's amazing. Kalman, yes, Kalman, that it was developed, initially to track missiles and all that. Everybody uses Kalman in different areas. Actually, it can be used in finance. Amazing. It's really beautiful. And then I also want to talk a little bit about portfolio optimization, okay? We do beamforming, right? We do linear filtering. Guess what? Portfolio optimization is really the same, okay? So let's go for it. Oh, before I start, I want to tell you about this. I want to tell you a little bit about financial data. What's special about financial data? I mean, we use data in all different areas, right? In communications, in speech, in image processing. We use data. So what's special about this? Let me tell you a little bit. I don't want to spend too much time, but a little bit. So there is this thing called stylized facts about financial data. The thing is that each market has a different type of data, but overall, all the markets share some special properties. Let me mention a few of them. But before that, let me start from the beginning. Let me tell you what are we going to play with. So this plot is just the price of a stock. Actually, we don't really deal with prices because it's difficult to model a price. So actually, we model the log price because the log price can be easily modeled as a random walk. Okay. So this is, for example, the log price of the SP 500 index. Okay. The problem with this is that it's not stationary, so it's not very nice to model. So actually, we don't use this. We use the returns, okay? So the returns is what you know already. So this is the typical expression for this is called linear return. It's just the variation of the price normalized with respect to the original price. That's it. This is when you hear Apple went up 1%, this is what we are talking about, okay? This return. But there is another type of return. We call it log return. Basically, remember, YT is the log price. So this is actually the difference of log prices. So if you write it down, you realize that this looks similar to this in a way, and actually they can be related with this function, okay? But in principle, there are two different types of return. But it so happens that the returns are usually very small numbers. So when you can do a Taylor approximation of this function, log of 1 plus x, and if you do that, you realize that the two returns are actually almost the same. So we can forget about this distinction, okay? Just returns to make it easy. Okay, so now I can plot the returns of the SP 500 index. Look like this. Okay, it looks a bit more stationary. It's not a random walk anymore, but still it's not stationary, right? You can see that the variance is high in some times, then it goes down. So these are the stylized facts about finance. So basically, we can clearly see here that it's not stationary. However, if you look at a small window, it can be stationary on a window. Okay? But it's tricky. It's tricky because of this non-stationarity. You can make models with some historical data, and then you don't know if later in the future the model is going to be good or not. So it's really tricky. It's really tricky. So let me give you a list. I mean, this is the list of these stylized facts. There are many. I just want to mention a few here. One of them is the one that I just mentioned, the lack of stationarity. Okay, really, this is very important. Okay, so yeah, watch out the funds brochures. When you read the brochure of an investment fund and they said, oh, the performance was fantastic in the past year, yes, but it doesn't mean later it's going to be good. So another important topic is the heavy tails. Okay. When I switched to this new area, financial engineering, this is the first thing that I encountered. I was so used to Gaussian distributions. In communications, we use Gaussian, and it's fine. But in finance, it's not fine. It's horrible. So that's the first thing I encountered, and that led me to working in robust estimators, actually. I'll talk about that. So another important thing that I want to mention, volatility clustering. If we go back, you can see the volatility clustering here. Oh, volatility is just the standard deviation, okay? It's like the envelope of the standard deviation. You can see that when the volatility goes high, it stays high for a while, and then it goes down, and it stays down. This is called volatility clustering. It's very typical, okay? So these things have to be modeled, of course. So, okay, let's take a look. I wanna illustrate a few points here. This is very important, actually. What am I plotting here? I'm plotting the histogram of the returns, okay? Like the PDF of the returns. I wanna see what is the shape. Is it Gaussian? That's the point. I wanna see if it's Gaussian or not. Why do we have so many histograms? Because of something. The subindex T that we were using, what is the meaning of T? This is up to you. T could mean day, and then you are talking about daily returns, or T could be week, and you are talking about weekly returns or monthly returns, so you can choose the frequency, actually. Now, I'm showing here the histogram for different frequencies, and it changes a lot, so that's very interesting. So for daily returns, well, you can say, the blue line is trying to fit a Gaussian, by the way. You can see, okay, maybe it looks like Gaussian, but actually no, I don't know if you can see it clearly, but the tails are heavy, okay? The tails are heavy, so Gaussian has a very, very thin tails. And here, there's no way we can say that this is Gaussian, okay? Now, if we look like weekly, it's the same, heavy tails. Now, monthly, still heavy tails, but something is happening. Something's happening in these low frequencies that it's becoming asymmetric. It's tilting to one side, okay? That's very interesting. So again, usually we don't model, this is called the skewness. Usually we don't model the skewness. We need to model, right? Especially if you are in these frequencies of the returns. And look at this, it goes crazy here. It's totally asymmetric, okay? So these are things that we need to take into account. Otherwise, nothing is gonna work, okay? Good. So yeah, let me skip that. So this is the volatility clustering that I was mentioning. You can see with the red, in red, it's like the envelope of the standard deviation. That's the volatility clustering. We need to model that. We cannot. Oh, by the way, if I didn't know that this was the returns of a stock, what do you think this looks like? In fact, to me, this looks like a speech signal, right? When you plot a speech signal, it also looks like that. So I don't know anything about speech signals, but actually, maybe there are things that people use in speech signal processing that can be used here. I don't know. Could be interesting to explore. Okay. Now, and this is the other issue. The frequency is very important. There are different regimes of frequency. For example, the common frequency is the daily returns. Daily returns, that's the one most people use because you can get the data for free online, and then you have enough data. So this is the typical one. Then you can consider low frequencies like weekly, monthly, but it's not so common because then you have less data that you can use for fitting models. And then, this is interesting, the high frequency. This is like this is very different. You enter in a different world. It's like the quantum world. Here, you get in intraday, and weird things happen. Once you go intraday, it's another world. I don't have experience on that area. I will get into that someday, hopefully. But weird things happening where people start playing games. And then you need to have really good computers, because speed is very important at that point. And also the data is very expensive. Data is expensive. So you need to pay, really expensive. You need to pay these very expensive subscriptions and Bloomberg, and so it's not the same. Okay. Anyway, so let's start with the modeling. Okay, we have these returns, and we want a model, right? That's what we do in signal processing. We use some model, we feed the model, and then we use that for predictions or whatever. So let's take a look. Basically, the idea is that we want to use all the information that we have from the past up to time t minus 1. We call this ft minus 1, is all the history. And we want to make a prediction for the next time, t. So we want to predict the return t. So this is our prediction. This is like the conditional mean. It's our prediction based on some model, whatever. And this is the error in the prediction, w, which has some covariance metrics. So anyway, forget the details, but the two important things is the mu t, our prediction, and the sigma t, which is the covariance metrics of the estimation error. Okay, so let's take a look at different models. There are many models. There are books on models. I mean, books that 1,000 pages on different models, okay? Most of the models, by the way, we know them in the signal processing community. So let's take a look. This is the simplest one, IID model, which is false, but people use it, to write papers. And Markowitz wrote this seminal paper in 1952, and he considered also this model. It's okay, it's a good approximation. Basically, you assume that the mean is constant, and the covariance matrix is also constant. That's it. That's the assumption. So another model is factor model. Also, we use it in signal processing. It's like an IID model, but you realize the following. You realize that the vector of returns can have a very large dimensionality, maybe 500 elements there, 500 stocks. But then you realize that actually all these stocks are driven by a few factors. A few could be just one factor, or 2 or 3 or 5. Then once you incorporate this structure, then you get like low rank covariance matrices and all these kind of things that we do in signal processing, right? This is, by the way, related to PCA, okay? PCA is when you don't know the factors and you want to estimate the factors. By the way, in finance, this model is very important. And in finance, they do it a bit different, though. In finance, they have the factors. They know the factors. How do they get these factors? It's very interesting. There is a whole market on data in the financial world. Basically, you have these big companies like Bloomberg and Barra. Those companies, they spend a lot of money creating these factors. They analyze the companies, they analyze the data from the companies, and they generate hundreds of factors for each company, and then they sell these. They sell this data to investment funds, hedge funds. Very expensive. This is really very expensive. So if you are a small hedge fund, you are not going to have enough money to pay for all these factors, for the good ones. You need to get only the cheap ones, and it makes a difference later. So there is a whole market on these things. Okay, anyway, let's move on. What about forget the IID model. What about the correlation in time? There is some correlation, not too much. Again, this also depends on the frequency that you choose, but there is a little bit of correlation. You may want to capture that correlation. We know this in signal processing, right? We've been doing this forever. So, for example, we have these models, the autoregressive models, that AR models, right? Basically, you express the return based on the previous returns, multiplied by some coefficient, and this is the moving average part. Anyway, we know these models, nothing new, okay? Good. And once you have a model, you can make the prediction of the mu, and then you can have the covariance matrix of the residual. Fine, we know these things. Let me tell you something that maybe we don't know, because this is very particular from finance, okay? What's the problem with this model? There are many models like this, many, eh? So what's the problem with these models? The problem is that we are modeling the returns. And if you remember, the log returns, they are the difference of the log prices. So we do that because when you take the difference of log prices, you get something stationary, and then it's easy to model, right? But you may be losing some structure when you take the difference of the log prices. And if you are losing some structure and somebody else is able to capture that structure, that person can make money and you're going to lose. So you don't want to lose any information. So already in the 80s, so nothing new, already in the 70s, these guys, by the way, these guys, all of them, they got Nobel Prizes and all that. So in the 80s, they proposed this. They included this error correction term, and in fact, they call this vector error correction model, VECM. And you can say, okay, what's the big deal about this? Okay, there is a big deal, because this matrix pi has a very particular structure. It's a low-rank matrix. The rank tells you a lot about how to invest, and the subspace generated by this matrix tells you a lot. We will talk a little bit about that later. But it's like a secret. This pi is like a secret parameter. If you can estimate it better than others, that's it. You are going to be able to make good money. So we are signal processing people. We know how to estimate things. We can impose low rank, sparsity. We know how to do this. So by the way, on Wednesday, one of my students is going to present a paper on this topic, how to estimate pi, and including low rank, sparsity, all that stuff. So anyway, I will not say any more about this, but well, the matrix pi is going to come up later. But that's like a secret parameter that we really want to estimate well. It's very interesting. I could talk for hours about that, really. But anyway, so, OK, what else? Any more models? Anything missing? There are hundreds of models, of course, but there is a big thing missing. It's the elephant in the room. What is the elephant in the room? I'm going back. Eh? What is the elephant in the room? Well, we have these sophisticated models, whatever you want. However, all these models, take a look, all these models have a fixed covariance matrix. The covariance matrix is fixed. We are just modeling the mean, but not the covariance. And we saw this phenomenon that is called volatility clustering, right? So we saw the variance has to change over time. It's not changing. This is horrible. You can be as sophisticated as you want modeling the mu, but you also need to model the variance or the covariance matrix. So again, hundreds of models for that, hundreds. So for example, and you can see, right, if you don't model the covariance, you get something like this. This is constant volatility, and this is real data. There are these clusters. So we need to model that. Eh? We cannot ignore that. So how do you do that? Very simple. In the model, there was this residual, right, that we call W. Okay, that W has the covariance matrix fixed. So now we are going to generate this W as the product of two guys. Z is like a normalized, random term with unit variance. And the sigma is going to provide the envelope. Now you can put models on the sigma. That's it. That's the idea of what all these hundreds of models do. They put some model on the sigma so that captures this volatility clustering. That's it. We don't need to spend more time on this. This is, and then again, a Nobel Prize for all these things in the 80s. And this is like one model, the first one, arch, and then the GARCH, generalized arch. Basically, again, you can see that there is like an autoregressive component. You see the sigmas in the past determine the sigma now, and then there is a moving average component. Eh? Many models like this. Anyway, good about that. So, and then it works fine. You can model the clustering. Good. So, this is when it gets crazy. All this is fine, but that was for a scalar residual. For the multivariate residual, we have a vector. Now, this guy is a vector, and this has maybe like dimension of 500. Now, you need to actually model a matrix that is 500 by 500. And yes, you can create models, forget the details. There are many models, but all these models have these matrix coefficients. Each of those matrices is like 500 by 500. What's the problem with that? The problem is that you cannot estimate those parameters reliably because you don't have enough data. You have too many parameters, not enough data, so you're going to do overfitting. Nothing is going to work. That's the message. So very tricky. So when you estimate, you need to impose low rank, sparsity. We know how to do that, right, in signal processing. So we can do a lot of stuff here. Anyway, let me move on. Now, how do you estimate those parameters? We know that, right? Signal processing, we do maximum likelihood, we do least squares fitting. We can do these things, and we can import sparsity. We know these things. We can do lots of things we know can be used here. So for example, this example, this is the vector model where the pi matrix, the secret matrix, has to be low rank. And then we also want to impose sparsity. So you can formulate some problems. So my student is going to present this topic on Wednesday, if you're interested. OK, let's move on. Let me talk about robust estimators now. What do I mean by robust estimators? I mean that we are going to consider that Gaussian distribution is not good. So now heavy tails. So let's see what we can do. In fact, we know all these things from the 70s, so nothing really new. So basically, consider the simple model IID. If you want to estimate the mean, how do you do? Sample mean. If you want to estimate the covariance matrix of the residual, what do you do? Sample covariance matrix. That's what I did when I was getting into financial engineering. This works really bad, okay? They are really horrible. Why is that? Well, the reason is that this sample is, by the way, of course, if t goes to infinity, we know they are consistent estimators, blah, blah, blah. But in finance, t doesn't go to infinity. T is the number of samples that you have, and you don't have so many samples. I mean, if you use daily data in 1 year, you have like 252. If the dimension is 500, you don't have enough data. So big problem. Anyway, you can actually derive these sample estimators as the maximum likelihood estimators, assuming Gaussian distribution, right? We all know that. So basically, you assume the distribution of the returns is Gaussian, you form the likelihood, and you derive the estimators. Indeed, sample estimators. This gives you a clue that, about why they are so bad. They are so bad because they are assuming a Gaussian distribution. And we know Gaussian distribution is a joke in finance. It's not Gaussian, heavy tails. So we need to reformulate everything from the beginning without assuming Gaussian. We can do that. Okay? So the two problems that I want to briefly mention is, one is the heavy tail issue, of course, and the other one is the small sample regime. As I said, if we have 500 stocks and 2 years of data, that's about 400 observations. We don't even have more observations than the dimension. As you know, that's a joke, right? At least you need to have more data than the number of parameters you want to estimate. I mean, so let's take a look. Small sample regime, we know this already in signal processing, going back to the 70s and 80s in the beamforming area, right? We know that already. This paper, for example, from the early 80s, we used the sample covariance matrix to design beamforming, and it was performing really bad. People realized that you could do this thing we called at that time diagonal loading. It was a heuristic thing, but it worked really well, diagonal loading. Later on, I mean, recently, we were able to, I mean the community, not we. So we were able to derive this diagonal loading in a more formal way from a robust optimization perspective and all that. Another word for diagonal loading is shrinkage. In fact, in finance, people use that a lot. In communications, also, this is related to people working in random matrix theory. Many people here working in random matrix theory. So basically, again, you assume some diagonal loading, but you need to estimate these shrinkage factors, and then you use random matrix theory to find them. Lots of papers on this topic, okay, applied to communications and finance. This is interesting. In 2004, these people became very famous because they proposed a very simple estimator of these shrinkage factors. And Ledoit was a student. He graduated, and then he went to the industry. He became a millionaire using his estimator. And now he still publishes paper. It's quite interesting. The state of the art now, as far as I know, is that this is like a linear shrinkage, very primitive. Right now, they are working on nonlinear shrinkage methods based on random matrix theory and all. It's very sophisticated. It's getting very sophisticated. Anyway, many people work on this area here, random matrix theory. Okay, good. Heavy tail issues. Again, nothing new here. We can go back to the 70s. Everything's done in the 70s, right? So we can go to the 70s. The idea is to assume that the returns don't follow a Gaussian distribution, follow some heavy tail distribution. For convenience, we can use the family of elliptical distributions. They look like this. Look, it's almost like Gaussian. They have like a mean and covariance. But instead of having the exponential, they have some arbitrary function g. G determines the thickness of the tail. So let's assume we know the thickness of the tail. Then that's it. We can do maximum likelihood. You form the likelihood, and you derive the solution. Done. Now, let's take a look at the solution. It's very interesting. If you take a look at the solution for the estimation of the mu, it's actually a sample mean, but with weights. Every sample is weighted. Interesting. And then if you look at the estimation of the covariance matrix, it's the sample covariance matrix, but with weights. There are these weights. This is really beautiful. So after all, you still get the sample estimate, but with weights. Now, of course, it gets complicated because the weights depend on the distance of the sample to the mean. But precisely, you still don't know the mean. You are trying to estimate the mean and the covariance. And now, the weights depend on the mean and the covariance. So actually, you see, it's a fixed point equation, right? This is very common in robust estimation. You have these fixed point equations. No big deal. You actually use iterative methods. And then, of course, you need to analyze whether they're going to converge or not. So it gets complicated. But we know this from the 70s. Look, Marona from the 70s. Iterative method, the iterative method is what you expect it to be. Basically, you have an initial estimation of mu and sigma, and that gives you the distances. With the distances, you have the weights, and you compute the next estimation for mu and sigma. And you iterate, that's it. Is it going to converge? Yes, we know from the theory from the 70s that it converges. Fine, very nice. But for all this, you need to know the tails. You need to know how heavy the tails are. You can estimate that, no problem. But there is another estimator that I want to mention because it's really cool. Tyler. Tyler in the 80s, he said, okay, I don't know how thick the tails are, and I don't want to know. So what he did is he took the samples, assume 0 mean here. He took the samples and he normalized the samples with the length. By normalizing the samples, you get rid of the tail. It's beautiful, and he derived the PDF of the normalized samples, and in the PDF of the normalized samples, indeed, there is no tail. The shape of the tail, the G function, is not here anymore. So this is always the same. It's really beautiful. So now you can do maximum likelihood on this. Really beautiful. And then you can estimate the mu and the sigma. This is the very famous Tyler estimator. Again, fixed point equation. Again, you see, this is like a sample covariance matrix with weights, and the weights are 1 over this. Again, fixed point equation. Again, you need to do an iterative algorithm. Again, you need to make sure it converges, conditions under which it converges. Very nice. 80s, everything done. What are we doing here? I don't know. So now, you really, this is very important, by the way. Robust estimation, it's a must in finance because, let me show you an example. Imagine these random points, the black points, generated from a heavy tail distribution with the shape is the black one. You see this ellipsoid here. Okay. Now, in this case, we have 4 outliers, 4 guys a little bit farther away. If you use the sample covariance matrix, you get the red estimation. Horrible. You're going to lose all your money. But if you use a robust estimator, you get the blue. Really nice. Really nice. This guy loses the money, and this guy gets the money. Very nice. Okay, now, something that was missing, perhaps from the 80s, was the combination of both. Combination of robust estimators for heavy tails and a low sample regime. So in a way, you want to have some kind of shrinkage together. No big deal, right? You just take, you know, the fixed point equation of Tyler, and you add a regularization term. No big deal. Yeah, of course, but this is very heuristic, okay? So people already, like almost 10 years ago, they realized this is a bit heuristic. So they were able to derive this diagonal loading from a formal perspective, and there are different ways of doing that, but one nice way is to formulate the maximum likelihood formulation, but with a regularization. If you include a regularization term, then you can get this diagonal loading nicely, and then you can develop the whole theory of existence, uniqueness, and then you can develop algorithms, iterative algorithms, so everything very nice. In the past, I would say in the past 8 years, different groups of people have been working on that, and I think now we have a nice understanding. Still, some things left to be done, but that's it. I need to move on. Okay. Now, does it work? Yes, of course. Of course. So this is the error in the estimation of the covariance matrix versus the number of samples. Okay. The more samples, the better, of course. But this is the sample covariance matrix. Horrible. Horrible. This guy here is the Leduat-Wolf estimator, the guy who became a millionaire. So it's here. So big improvement, of course. But still, not very good, right? Because it's still assuming Gaussian. It's still assuming Gaussian. And now you have Tyler. This is the Tyler one, really nice. However, Tyler only works up to, you need to have more samples than the dimension. In this case, the dimensionality was 40, so at least you need to have 40 samples. So, but now when you combine the shrinkage with Tyler, then you get this beautiful one, and also this one, these two. So beautiful, beautiful, right? We can do nice things. Okay, let's move on. Kalman, yes, I really want to talk about this today, Kalman. So let's start with this. Cointegration. I need to tell you about cointegration. Again, cointegration is one of these concepts that it's specific for finance. I mean, we don't know these things in other areas. It's very specific for finance. It's very interesting. The idea is the following. The idea is that it may be difficult to predict the stock of the price of stock 1, and it may be difficult to predict the price of stock 2. But it may be easier to predict the relative pricing. And you can use that to make money. It's really beautiful. The analogy that people use to explain this is imagine a drunk man with a dog. Okay? So this guy is walking in the street. He's drunk, so he's doing a random walk, precisely. Now, you cannot predict the path that he's going to follow. It's a random walk. Okay. Then the dog. The dog is there, like peeing, moving around. You cannot predict the path of the dog either. It's a random walk. However, you know that the dog is going to stay together with the master, or vice versa, maybe. They're going to stay together in the long term, right? Even 1 hour later, they are still going to be together, right? That's cointegration. That's it. Isn't that a beautiful idea? So let's take a look. Let me tell you formally what is the definition. So correlation, okay, we know correlation, right, in signal processing. Correlation of two random variables is high when they co-move, and it's zero when they move independently. Okay, everybody knows that. Now, if you read the definition of cointegration, looks like this. Cointegration is high when the two quantities move together. Okay, sounds the same. Cointegration is inexistent if the two quantities do not stay together. Sounds pretty much the same. So is it clear, the difference or not? Well, it depends. It depends. It took me a while to understand the difference. But I can show you some plots that you will see the difference is really clear. But let me tell you a very simple way to understand the difference. Basically, correlation, you can think of correlation as telling you the short-term variations of the two stocks. If the variations are similar, then you have high correlation. But it's a short-term thing, only the variations. Cointegration is more about the long term. You don't care so much about the small variation. You care about the long term. So it's very different. And let me illustrate. Look at the two curves, the blue and the red, okay? They represent log prices of two stocks. Okay, so they are random, right? Now, if you look at the variations, they are highly correlated. You see, when the blue line goes up, the red goes up. When it goes down, it goes down. So the variations are highly correlated, and I'll show you later a scatter plot. They are like totally correlated, pretty much. The variations are highly correlated. These two guys are highly correlated. However, look at the long-term behavior. They started together, and after a while, they drift apart. In fact, if you take the difference between the two curves, you get the black one. You see, the black one is drifting away from zero. So that means there is no cointegration. Okay, one line is the guy, and the other line is the dog. They don't stay together, no cointegration. So indeed, if I show you the variations, the log returns of stock 1 and 2, they are highly correlated. So you see, that was an example of high correlation, no cointegration. And I can show you the opposite example. Look at the two plots, right? The blue and the red. If you look at the small variations, they are uncorrelated. When the blue goes up, the red goes down, or uncorrelated. However, in the long term, they stay together. Is the dog and the master. There is cointegration. If you take the difference between the two guys, you get this black curve, which stays around zero. Okay? So now we're going to talk about this black line. The black line is very important. It's called spread. That's the one you're going to use to make money, to trade. You are not going to trade on the stock, on the blue stock. You are not going to trade on the red stock. You're going to trade on the black. You can think of the black line as an artificial asset that you have created, and then you're going to trade on the artificial one. That's the idea of pairs trading. It's called pairs trading. Very interesting. It's really beautiful from a signal processing perspective. Cannot get more beautiful than this, right? So, the variations are totally uncorrelated, indeed. So, hopefully it's a bit clear now, the difference between correlation and cointegration. Luckily for you, it took me like 2 years to understand the difference. I mean, okay, now I don't want to get into the mathematics, but just one small thing, so that you can appreciate the beauty. Look, this is a simple model for the log price of stock 1 and log price of stock 2. Okay, they have a common trend. This is called X is a common trend. It's like a random walk, right? And then they have an individual residual, another component that is zero mean, and this guy another one. Okay, now as I said, it's difficult to predict these guys because they have this common trend that is a random walk. However, the beauty is that the trend is common. That's why it's called common trend. And you can see that you can multiply y2 by gamma, and you can subtract that from y1, and then you get rid of the common trend. That's how you get the spread. In fact, this is what we call spread. Basically, in this case, is y1 minus gamma y2. You see? And you get this. There is no common trend anymore. All that you have here left is just the residual, which is zero mean. That's the spread. You are going to trade on that. Okay? It's really beautiful. Now, again, it's beautiful because you need to know the gamma. First of all, you need to know that you need to find the two stocks that are cointegrated. Not easy, because you have like hundreds, thousands of stocks. You need to find 2 that are co-integrated. And then you need to find the gamma. The gamma is a secret thing. We have 2 secret things today, right? The pi matrix and the gamma. In fact, they are related. Inside the pi matrix, there is the gamma. It's really beautiful. So anyway, that's it. Let's see. Oh, the important thing about the spread is that because it has 0 mean, it has this property. It's mean reverting. Mean reverting means that it can go high, but you know it's going to come back eventually because it has 0 mean. You use that to trade. And let me show you how you trade a spread. Very simple. This is the idea. The black line is the spread. Okay, you know it's mean reverting. And so you set 2 thresholds. This is one threshold and another threshold. So for example, when it goes down, when it crosses the threshold, you know it's undervalued. And you know that eventually it's going to go up because it's mean reverting. You buy at that point. And say when it recovers and goes back to 0, then you sell. And so you make money. You make the difference. The difference between this price and this, that's it. That's the money you make. Bam. It's like money for free. What can go wrong? What can go wrong? So that's it. Every time you do a trade, you are making that amount of money determined by the threshold. This threshold that you choose. This is the threshold, right? And again, when it goes up, it's overvalued, so you do short selling. And then when it goes down, you buy to unwind the position. That's it. I'll show you later how this works with real data. Okay, now, how do you estimate the secret gamma? It's secret. So yes, very simple. Well, to discover pairs, you can just do brute force if you want, and there are more sophisticated methods, but you can do brute force. To estimate the gamma, just least squares. We're going to see it in the next slide. Least squares, very sophisticated. Of course, you can do actually more sophisticated things. Actually, from the Veckem model that I mentioned before, the secret pi matrix, which was low rank, if it's low rank, you can write it as alpha times beta. Beta contains gamma inside. It's really beautiful. No time. Really beautiful. So let's see, least squares. Let's do least squares, okay? I cannot believe I'm giving a plenary telling you how to do least squares, but look, remember, this is the spread, right? Now, because it's a spread, we know it's mean reverting, so we know it's basically a mean and some 0 mean residual, right? So it's mean reverting, okay. So then you can move this guy to the other side, and you can write it like this. No, it's okay, it's the same thing. But here you can see you can do least squares, right? Basically, you can regress y1 from y2, and then you can estimate the gamma and the mu. Least squares. So you have some observations. You have t observations, and you take the difference of these, you take the square, and that's least squares. You do it, done. Let's see how it works. This is an example, okay? A real example. I did it last week. So this is, here I take 2 ETFs. So let me tell you what we are seeing here. Basically, the black curve is the spread, okay? The black. So what you want to see that the black curve is going up and down as many times as possible. That's what you want to see. Because every time it goes up and down, you are making money. How do you make money? As I said, when it crosses the threshold, you buy. So then that's actually the red. The red curve is the signal. The signal can take 3 values, 1, 0, or minus 1. 1 means that you buy, 0 is that you unwind, minus is that you do short selling. Anyway, so again, you make money when the signal is going up and down, every time, up and down, you are cashing money. That's it. And here I'm plotting the wealth. This is the wealth. So you see, every trade gives you a tiny amount of money, okay? Of course, there is no magic. Every trade gives you a tiny amount of money, but you are accumulating a lot of these trades. Bam, 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 bam. So basically, it looks beautiful, right? It really looks beautiful. You're accumulating all this money. By the way, what is this blue line here? This blue line refers to the training phase. So I use all this data for training, and this data, actually, what am I doing? Sorry. This data is for training, and this is the actual trading. So what you see here is, of course, during the training window, of course, you make a lot of money, but after the training phase, you are still making money. Good. Everything looks nice. Now, the next sample is the bad one. Something happens. What happens is that because things are not stationary, the regime has changed, and the co-integration has been lost, the gamma has changed. And if you are using least squares and you don't adapt, look what happens. You train, the spread looks fantastic in the training phase, but after that, it drifts. You are losing all this money, and this is like 1 year. You are losing money for 1 year. You design your fantastic gamma, least squares, you put your money, the whole year losing money. So yes, it's not easy to implement this in practice. Okay, so that's when Kalman comes in. Kalman tries to adapt to the variations of gamma and mu. So, very simple, the solution is Kalman. Let's take a look. It's the same thing, but now mu and gamma, we assume that they are time varying. That's it. And we introduce some model on the variation of mu and gamma. This model is nothing really, it's just from one time to the next, there is some additional noise, whatever. So you see, for those of you familiar with Kalman, this is the state transition equation, and this is the observation equation. So that's it, Kalman, okay? The typical Kalman, right? The state transition and the observation, and in this case, the hidden state is the mu and the gamma. That's it, I'm not gonna tell you any more thing. Kalman, that's it. So let's compare. Let's compare with real data. This is the log prices of 2 ETFs. I chose this, because you can see in this part, in the first part, the two curves, they maintain the distance. So they are co-integrated, okay? They stay at the same distance. But here, things have changed, and then co-integration is lost. Later, it recovers again, but you see, let's see what happens with least squares and Kalman and all that stuff. Okay, so this is the tracking of the mu and the gamma. So it's tracking, of course, Kalman does tracking. So it's actually tracking, yes. So least squares, it uses up to this blue line for training, and then it doesn't change. So you see the black line is the estimation of mu using least squares, doesn't change, and here the estimation. Now, the green one is Kalman. So in the initial period, it coincides with least squares, of course, it should be, but then at some point, when the co-integration changes, it adapts. Okay? Good, and here it adapts. Now, what is the red one? The red one is, I try to use a rolling least squares. Why do you need Kalman? You can just use least squares, but on a rolling window basis. Ooh, right? We don't need to get too sophisticated. Well, guess what? It doesn't work well. What happens is that there are too many parameters to fit there. So if you use the rolling window too large, it doesn't adapt fast enough, and then you lose a lot of money. If you use the window too small, it's really noisy. When I say really, it's like unacceptable. It means that the red line, it would start oscillating like crazy, off the charts. Now you say, okay, instead of rectangular window, I can use some exponential or triangular. Okay, yes, but you are doing overfitting then. I mean, for every pair, you need to choose the right window, the right length. It really doesn't work. With Kalman, you don't need to worry. It just works. Good. So which one works better in practice? Let's take a look at the spreads. Again, what do you want to see here? These are spreads. What you want to see is something around zero, something that oscillates around zero. So for example, the black one, least squares, in the training phase, yes, fine. In the initial phase where co-integration is nice. But here it gets lost, and you see the black line goes up. It doesn't stay around zero. You are losing money like for 2 years, and then it comes down and then down. You lose money again for 2 years. You are dead. So look at the green one. The green one stays around zero. Tick, tick. So let's see the trading. Let's see the trading with the Kalman, trading with the green one. So it's nice. Look at it's beautiful. So the black one, the spread is really beautiful all the way. It adapts. It can adapt, right? And if you look at the cumulative P&L, the wealth, it goes up, yeah, maybe some period a little bit down, but overall, nice. Now, final comparison. Let's compare least squares, rolling least squares, and Kalman, just to prove the point that indeed Kalman works well. It's this, right? So the black one is least squares. It works well up to some point, and then really bad. Then rolling least squares, it improves a little bit, but this is cheating. I cheated here, as I told you, because I did overfitting. I just chose the right window length, the right window shape, so that rolling least squares work fine. In practice, I'm never going to use rolling least squares. You can use it if you want. And then Kalman, fantastic, right? So really beautiful. So I don't have time to talk about discrete state hidden Markov model, but basically, this is used to detect the regime, right? I've seen this used to detect the state of a channel, whether you can think a channel that is in a good state or a bad state, and I've seen papers using HMM to detect whether you are in good channel or bad channel. Same here, right? In finance, you really, the investment strategy is going to change depending on whether you are on a bull market or a bear market. So you want to know what type of market you are in this particular moment. So this is regime detection. HMM, you can use it, no time, sorry. But basically, you do it, and you can detect different regimes. It works actually, surprisingly. Okay, so let me talk about portfolio optimization. God, I want to talk about this. Again, I could talk about this for hours. I mean, this is actually, I like this topic because my topic is optimization. So I like this because you will see, this is like beamforming. People who know beamforming, people who know linear filtering, everybody knows linear filtering. This is portfolio. You will see, it's really beautiful. So first, let me tell you a notation, okay? What is a portfolio? A portfolio is actually a vector with weights, okay? We call it W. Now we normalize the weights, okay? Basically, each element of W tells you how much money you put on a stock. And remember, maybe we are investing on a universe of 500 stocks, so this Beam vector is 500. So, okay, so it's normalized, but in real life you have a budget, B, so actually the amount of dollars is W times B. Anyway, doesn't matter, we just use the normalized one. So it turns out it's easy to derive that if you use this portfolio W and RT is the return of all the stocks, 500 stocks, the inner product between W and R gives you the return of the portfolio. Okay? Just believe me, it's easy to derive. So it's quite nice, right? Very nice. Now, this model looks very familiar, right? It's the typical model that we use in beamforming and linear filtering. Oh, by the way, let me mention one thing. Now, given that this is the return of the portfolio and that RT is random, it's a random vector with mean mu and covariance sigma, that means that the expected value of the portfolio return is this, and the variance of the portfolio return is this, okay? These two quantities are key. We are going to use them later to design portfolios. Remember these two quantities. These two quantities are the two quantities that Markowitz used in 1952 to write his very seminal paper, okay? Very important. Anyway, let's look at the signal model. Let's compare with beamforming. Beamforming, we have an array of antenna elements, and we receive the signal, and we call that snapshot, right? So xt is like a vector containing the signal from all the antenna elements. We call that snapshot. And then we multiply each guy by a weight, and we add together. That's beamforming. In fact, W is called beam vector, right? This is the same for linear filtering, right? In xt, you would put the samples from the past times, linear filtering. Good. So look at the model. What am I doing? Look at the model for portfolio is the same. The same. The only difference is that here we use transpose, so it's because everything is real valued. And here we use, Hermitian. It could be complex valued or real value, depending up to you, right? Depending on the. But here, yeah, we don't have complex valued numbers in finance. As far as I know, I haven't been able to find a reason to have complex valued numbers. But maybe somebody has an idea. That would be very interesting, right? But anyway, now, okay, you do this filtering or beamforming, and now the good signal comes from some particular direction. Let's call A. Then you can write this as the signal power, the good signal power, right? And then you can write this as the interference plus noise power, right? We do that all the time. Now, in finance, well, if you take the expected value of this is like the good stuff. This is the good stuff, portfolio return. And this is the volatility. The volatility is actually the square root of the variance. Okay, you can see these similarities. Now, in communications or signal processing, we use the ratio of this to this. We call that signal to noise ratio, right? And if you buy a router for home, and you open the specifications, technical specifications of the router, you're going to see SNR all the time. Oh, SNR, 3dB, SNR. So we use SNR a lot. Guess what? In finance, they also take the ratio of this to this. And they gave it a different name. It's called Sharpe ratio. Okay? So Sharpe, by the way, Sharpe got the Nobel Prize as well. So Sharpe proposed this ratio. It's called Sharpe ratio. It's pretty much the signal to noise ratio. Basically, the only difference is that this is like the square version of this. This is square, that's it. But it's the same thing. And again, if you take a brochure of an investment fund, they're going to tell you the Sharpe ratio. If you didn't notice, then the next time somebody comes to you trying to sell you some investment fund, take a look. They will say, oh, look at the Sharpe ratio. So they really use Sharpe ratio. It's fascinating. Anyway, so this is the Markovic portfolio. He wants to maximize the expected return and minimize the variance. Very simple convex problem, QP. Nobel Prize for this, but it was revolutionary at the time. It was really, because he was the first guy who introduced the variance there. So it was really revolutionary. Now, if you just want to minimize the variance, you get this. It's called minimum variance portfolio. Guess what? You know, in beamforming and linear filtering, there is something called minimum variance distortionless response, right? And it's exactly the same. It's really the same. So at least in the beginning, Markovic is really the same. And then Markovic, not Markovic, but portfolio optimization can get more complicated later. I don't have too much time, but I want to tell you a little bit. So basically, two problems with Markovic, okay? Two big problems. In fact, Markovic is not used in practice. Nobody uses Markovic. He got Nobel Prize. Nobody uses in practice. Why? Many reasons, but one of them is people don't like to use variance as a measure of risk. And they have proposed more sophisticated measures. No time to talk about that. But just let me tell you that people in signal processing working in topics like stochastic optimization and chance constraint, I know one of the organizers, Kalman, works on chance constraint, you can do something here. And then another reason why Markovic is not used is because it's very sensitive to the mu and the sigma. Remember, mu and sigma are estimated, and there is a lot of estimation noise. So what happens is very sensitive, doesn't work at the end in real life. So then you need to do whatever you can, but we use robust optimization. Again, a lot of people here do robust optimization, robust beamforming. We can do a lot of stuff. Good. Now, with the little time that I have, I want to talk about two different portfolios. Index tracking, quick. What is index tracking? Very simple. An index like SP500 is a definition. It's a definition that you say, okay, I'm going to include in this definition 10% of this stock, 30% of that, 50% of that, but it doesn't exist. The index doesn't exist. It's just a definition. What if you want to create the index? You can do that, right? How do you do it? Just buy 10% of this, 20, 50, you create the index. But then SP500, you need to buy 500 stocks and keep rebalancing every now and then 500 stocks, paying the transaction costs. Nobody does that in practice. What do they do in practice? Sparsity. Instead of buying the 500 stocks, they want to track the index, but just using, say, 40 stocks. Sparsity. That's it. This is sparse regression. I don't need to tell you more. We know this in signal processing. We do this all the time. You define a measure of error, right? In this case, L2 null, and you want sparsity. It's non-convex. We know how to deal with this thing. No problem. Works really well in practice. These are benchmarks that people use, and this is the tracking error. So the tracking error using our signal processing regressors, fantastic, great. A lot of room for things to do for people working on sparsity. And let me finish with this. Oh, it tracks very well. Look, just to show you. The blue line is the index, and the red one is the one we generate with 40 stocks only. So we track the SP500 with only 40 stocks. And the Greek one is an improvement that we propose. Basically, in the tracking error, instead of penalizing when you do worse and better than the index, if you only penalize when you do worse, but you don't penalize when you do better, you get the green one. So you can actually do better. It's very nice. Let me finish with pairs trading. Pairs trading portfolio. Now, I'm not going to go into the details because there is no time. But remember that I talked about that magical matrix pi in the Vecken model? OK. So that magical matrix pi, first let me tell you one thing. When we were doing pairs trading, we were doing pairs trading with two stocks, right? We were buying one stock and minus gamma of the other stock, right? That's like having a portfolio with two components and with weights 1 and minus gamma. That's an important realization. So when you do pairs trading, you're actually using a portfolio. But what stops you from having more than two stocks when you do pairs trading? Can you do pairs trading with more than two? Yes. It's not called pairs trading. It's called statistical arbitrage. It gets more complicated because then you need to find like more gammas. So we can do that with the Vecken model. It's really, it starts getting complicated, but it's really beautiful. Anyway, and that's how we come to the pi matrix. The pi matrix is low rank, so there is a beta matrix. The beta is the key, is the magical one. Beta is beautiful. Beta gives you a subspace of mean reverting spreads. So let me repeat. Imagine you have 500 stocks. They are random walks, right? All the stocks. If you feed the Beck model, you're going to get a small subspace of mean reverting spreads. And now you can do pairs trading on all these guys. But it's a subspace, so some directions are better than others. Can you find the best direction? On Wednesday, my student is going to talk about that. Indeed, you can try to optimize a portfolio within that subspace, and then you get the best direction. So let me just show you the final result. By the way, the formulations, they start getting complicated. So you start getting like non-convex. It's non-convex problems and that, but we are signal processing people. We know how to deal with these things, right? We can do it, no problem. But everything is non-convex at this point. Yeah? Let me just show you this. The final result is this. The blue line is the wealth that you can make just using the magical beta. The red one is when you optimize the direction within the subspace given by beta. Clearly, you can do much better. So it's really beautiful. It's all signal processing, right? All signal processing. So let me summarize. I have talked about different topics. Different people are going to work in different topics. Some of you random matrix theory, some of you on robust estimation, on Kalman, particle filtering, shrinkage, random matrix theory, robust estimation, robust optimization. All these topics fit perfectly financial engineering, really. So it takes a while to get into the new area, but some publicity. This is a book that we wrote. It was published in 2016. This is the book written for signal processing people. So look at the title, A Signal Processing Perspective on Financial Engineering. So it's written for signal processing people. This is the book that I would have liked to have had 10 years ago when I started. 10 years ago, I didn't know what to read. This is the book that is an entry point. You guys can easily read and see what you can do. Oh, by the way, graph signal processing, that is very popular now, can be also applied in finance, okay? Of course, deep learning and all that. So this is easy. By the way, they told me that you can get it for free, by the way. If you go to the webpage of the book, you get it for free during a few days because they know I'm giving the plenary, so you can get it for free, okay? So thank you very much. This is all my students that have been working together, and this is my beautiful campus in Hong Kong. So thank you very much.
Thank you, Daniel, for a very engaging talk. Do we have questions from the audience?
So thanks for the talk. Sir, oh, sorry. You mentioned Kalman filtering, and heavy tails are important in this problem. How do you help the Kalman filter out in the heavy tail environment?
That's a very good point, right? Because I talked about Kalman, which is assuming Gaussian, and then I talk about heavy tails. Indeed, if you think that in that particular model the distribution of the residual is not Gaussian, indeed, then you should use some extended Kalman filtering, or you can use particle filtering. Yeah. So I know some people who work in particle filtering topic, they try to apply these things in finance. So definitely, room for all these things, yes.
Actually, Kalman filters do not have to be, you can do robust Kalman filters. Like you can have outliers in the state and outliers to account for the heavy tails.
So it's true, there are a lot of things, but what things would you actually trade on?
So at the end, in this particular area, at the end, you trade on the spread. So, but there are other ways to trade. This is just one particular topic. The other portfolios, like the index tracking is different, Markowitz is different, so there are different approaches. In fact, let me tell you this. This is, I think, is very illustrative. So there are like two families of strategies for investment. One, imagine the prices, right? The prices have this noise, but they have a trend. There is one family of strategies that try to make money based on the trend. And the small variation, they treat that like noise. So that's bad. So they want the trend. That's like Markowitz. On the other hand, the pairs trading does the opposite. The pairs trading doesn't care about the trend, because when you form the spread, you remove the market. So you remove the trend, and you make money with the noise. It's really beautiful. Some strategies make the money with the trend, and some others on the noise.
Oh, okay, thank you.
Thank you, Daniel, for a very energized talk. I was just wondering, the major difference between learning and estimation, right, is the generalization capability. And in financial engineering, I suppose you want to learn not only to estimate, but to go beyond the data. So what people have tried from machine learning that works in financial engineering? So why don't you use support vector regressions and the like, for example?
Okay, yeah, of course, fantastic question. So the traditional approach is to have a model from statistics, and then it can explain things about the phenomenon, but maybe the prediction is not good. Then you have machine learning. They don't care about the modeling, black box, but prediction probably is better. Yes, so people now try to use deep learning in finance. Now, everything is very secretive in that area, unlike other areas where people just get a result and they publish it, and so everything is very fast, right? In this area, everything is very secretive. Nobody is going to tell you if they have succeeded in something and that. There is a problem in finance. The problem for using deep learning in finance is the lack of data. For deep learning, you need lots of data, and for people working in images, they have lots of data. But you don't have so much data in finance, in general. It's very limited. So you need to be very careful. Of course, you can always find some specific area in finance where you have a lot of data, yes. Especially if you go to intraday data, maybe you have enough data. So it's not easy. So I know many people who are trying. You never know if they have succeeded or not. They're not going to tell you. But it's not easy because of the lack of data. And so, but yes, definitely, I know everybody's trying. So my answer is yes. Everybody's trying. Nobody's telling the successes. So
thank you.
In your talk today, so you define the notion of a co-integration between two time series. And I can imagine that people may be interested in checking whether 3 or more time series basically co-integrate together or not. And then how one can generalize the notion into the more than 2 series.
Yeah. So this is what I mentioned. Sorry, I mentioned this too fast, but this is the idea here. The idea is this, precisely, that the pairs trading is only for 2 stocks. So you have 1 and minus gamma.
Yes.
But now if you want to have multiple stocks, W is going to be a long vector, maybe dimension 500. How do you estimate that? Well, one way is from the Becken modeling, from this magical pi matrix. That's one way of doing it. Because the beta contained in pi gives you this subspace, and then you can use that subspace and then to play around. So that's one way of doing it. Yeah.
Thank you.
It's called statistical arbitrage when it's more than 2.
I enjoyed your talk. Could you address the following question? If you're really successful, you will fail because you will move the market.
Okay, let me process it. If I'm really successful, I will fail because I will lose the market. Oh, in fact, yeah, this is true. I mean, if like big companies, they have so much money that when they invest, they are driving the market. That's a big issue. It's not my case, right? Individual investors are nothing, but it's true. So, and then there is a whole topic in finance. It's called the order execution. It's how to execute the order, because if you have a huge order and you execute it, you're going to kill yourself, indeed. So there is a whole branch on how to, basically what they do is they chop the order into small pieces, and they send the order slowly, so that they don't drive the market. So there is a lot of optimization there, because you want to know how to chop it off, how long, and so it's a really beautiful topic, yeah. In control theory, there are many papers in control theory on that topic. Can get very mathematical on that. So yeah, very nice.
Okay, I would suggest that we take further questions into the coffee break. As I said, there are 2 ways to get to the coffee breaks. There's 2 stations over in the poster area. You can actually go through here or right in front of the foyer. But first, thank you again for the excellent talk.